So, good afternoon, everyone. This is RJ Kelly. I'm founder and chief visionary officer for Wealth Legacy Group here in San Diego. We've got clients in 23 states, but we are blessed to be here in this beautiful city, and we're delighted to have you joining us here. We'll give another minute just to let folks come in and join us momentarily. So again, welcome. My name is RJ Kelly, and we're just delighted to have you join us today. And we've got some great talent. One of those talented people that's going to be with us is Drew Moser. Several years ago, I was just really felt convicted as a follower of Jesus that I was supposed to be doing something about the homeless issue here in San Diego, but I had no idea where to start. I just knew that it was a concern to me, it burdened me to see people and would walk by or just have conversations with folks. And it just seems so pointless to hand them I had little gift certificates from McDonald's for $20. So I would give them a gift certificate, but it just didn't seem like enough. And so in the course of researching and looking for who is doing something to really make a stand-up difference in a homeless situation here in San Diego, I came across this group called Lucky Duck Foundation. And the more that I got to know about them, and the more I got to meet this incredible executive director who is on my left on our screen here, Drew Moser, who's going to share with us a little bit about Lucky Duck in a few minutes. Not only was I incredibly impressed with what Drew and who he is and what he stands for and what he believes, but also what Lucky Duck has been able to do in having tremendous efficacy, having tremendous impact. And nobody's paying them any money in terms of they're not accountable to anybody in terms of being on somebody's payroll. No, they can just do things to make a difference, and they don't have to wait for permission. Incredible story. So I'm so excited, Drew. Thanks so much for making time to be with us and to share the awesome story of Lucky Duck Foundation. And then, again, true confessions. I'm an independent registered investment advisor. Wealth Legacy Group, we have only about 2% of us in the country that are independent. Everybody else is with a broker dealer. And again, no offense to anybody who is using a broker dealer or to any broker dealers who might hear this, but I found that they didn't bring us any value. I have an outside law firm that we have on retainer to keep us on the straight and narrow, because those rules are pretty important when it comes to investments. But I didn't find they add value to our clients, and they certainly didn't add value to us at our firm. So we're one of only about 2% of financial advisors that are truly independent, which means that we get to bring the best and the brightest to our clients, and we don't have to go through the compliance complexities of a big broker dealer. We do the compliance, and that's part of my job as the registered principal. But in the course of that, I had seen offering after offering after offering in this thing called opportunity zones. And I just didn't like them. They were unspecified funds. They were saying, okay, hey, the Tax Act is great. Give us your money. We don't actually have a property identified yet. And we're not sure what we're going to build on them, but that's okay. The tax rules are so good. You should just give us your money. And going, no, I'm not going to do that for me. I'm not going to do it for any of our clients. But fortunately, another good friend in the space said, you need to meet the folks up at Pinnacle Partners up in Washington State, but they've got projects all over. But this is a group that does the job right. And the co-founder and the CEO, Jeff Feinstein, is, from the minute I heard him on YouTube and then had a chance to interview him, and then now have worked with him for a number of our clients, I thought this guy is the real deal. I love their story. I think you will as well. So, but I've promised several of you that we're going to look at some additional ideas in addition to opportunity zones. So we're going to do a little thin slice on that. But without further ado, Drew Moser, Lucky Duck Foundation, who are you? How is it you've been able to have such significant impact? And tell us more of the story about Lucky Duck.
Thanks, RJ, and it's good to be here with all of you today. So I'll share my screen here in a minute and give some visuals to who we are and what we do. But our mission is to prevent and alleviate the suffering of homelessness throughout San Diego County. And our mantra is to share your luck. If you consider yourself to have had some good luck and good fortune in your life, share that luck with those in need. And our co-founders, to encourage that mantra, they personally match all donations up to $1.5 million per year. People usually ask me where the name comes from. There's some Irish heritage, so luck of the Irish. And then Pat Kilkenny, our co-founder, is an Oregon Duck through and through. He went to school up there. He's a major benefactor, and he actually served as their athletic director for several years and did some pretty special stuff with some other really special influential people up there. And so they care deeply about the community and helping those in need, and started this foundation in 2005. And then homelessness became this sole emphasis in 2017, shortly after Peter Seidler, the late owner of the Padres, took it upon himself and teamed up with Dan Shea, longtime business leader, to figure out what they could do to influence change and urgently help those in need. And so that's our mission. We think homelessness is the most pressing issue in San Diego County, and our group tries to apply sound business principles to a massive social issue. And to allude to what RJ said, we don't pursue government dollars. We're all privately funded. We pursue government to do its job, which I'll get into in a minute. So everything we do ultimately falls into three buckets in my mind. The first is programs that we own and operate ourselves. One example is bridge shelters. These, hopefully you can see the screen. RJ, can you see the screen?
You're coming through loud and clear. Yep, looks good.
Okay, good. So this is what we call a bridge shelter. The foundation purchased and owns this asset along with one other one, and we donate the use of this to the city of San Diego because they can come up within months and provide hundreds of shelter beds for literally pennies on the dollar and seconds on the hour compared to the cost of adding housing. Government loves to talk about adding housing to house the homeless. And hey, that's an ideal outcome, but it's years, if not decades away. We're focused on the here and the now, and how can we help people move off the streets and get a roof over their head.
And Drew, if you would, what does it cost for one of those facilities, one of those shelters?
Round numbers, $10,000 per bed all in, compared to $500,000 per permanent housing unit to construct it or acquire it. So it's different stratospheres for sure.
Amazing.
These are winter coats transformed into sleeping bags that are made by formerly homeless parents who are hired full-time to manufacture them. Over the last 4 winters, we've distributed over 12,000 of these coats as a way to provide some level of warmth and protection, while also calling on government to stand up more inclement weather shelter beds. There's not nearly enough shelter beds, let alone inclement weather shelter beds. So it's a way for us to try to alleviate suffering now, keep some folks warm, and push on government. And now that we've been doing this for several years, we've had several people who have moved off the streets into housing, gained employment, sobriety. They've come back to us and said, that coat literally saved my life. So they truly are life-saving. Another Lucky Duck ongoing program is something we call Cash for Trash, that pays people $2 for, pays homeless individuals $2 for every bag of trash that they clean up from their encampments and from downtown city streets. And it's removed over 200 tons of trash in, oh gosh, I don't know, a year and a half or so. So those are a few examples of like ongoing Lucky Duck Foundation programs in the first bucket. The second bucket is we're all about collaboration and standing up and working with credible organizations to stand up, impactful programs that are tangible and measurable and can make an immediate impact. This photo on the left is from Timmy's Place, which is a pizzeria and a print shop, which trains and employs homeless youth, that we launched about a year ago. It's already employed over 30 youth. It's located at a homeless youth center downtown, where transportation can be a barrier for so many youth. They just have to come downstairs and go to work, and oftentimes it's their first employment opportunity. And getting to know these kids and hearing their stories, it's pretty remarkable, their resilience and what they're trying to put behind them and where they're trying to go. And then this photo on the right is a program of, or it's an image of a program that hires shelter residents from the Salvation Army, trains them as food rescue route drivers. Feeding San Diego provides that vehicle, and they provide all the rescue routes, and then we provide Lucky Duck provides the funding to pay Emiliano, cover all the wages, plus the gas and the maintenance and insurance to make the program go. It's rescued about 670,000 pounds of food. And just about every person like Emiliano that's gone through it has secured long-term employment and they're still housed. So both of those we've funded more than 25 different employment job training programs. These are two examples, and they're examples that none of us could do on our own, but by coming together with no concern for credit, we can create some pretty meaningful outcomes. The third bucket is we try to take a leadership role in this space. We regularly host symposiums, gatherings of government leaders, service providers, the Regional Task Force on Homelessness, the San Diego Housing Commission, other philanthropists, et cetera, to get folks in the same room and dialoguing, because it can be a very disjointed system. And we learned that a lot of these organizations weren't even talking to each other. And so we try to unify the region's approach in a more deliberate, less competitive, but more collaborative way. We also, Peter and Dan, started a Tuesday group meeting back in 2016 of credible business leaders to study the issue and really determine what the private sector plus philanthropy could do to influence change. And Peter was adamant that we meet every single Tuesday. And still to this day, the group hasn't missed a Tuesday meeting, including all holidays, Christmas Day, New Year's Day, 4th of July, you name it. And then those symposiums I mentioned are a wider or an offshoot of the Tuesday group and a broader, wider invitation list and discussion. And then one other way, there's several different examples I could give you, but one other quick example in the leadership bucket is something we call shamrocks and shipwrecks. It's a public scoring system meant to quantify and evaluate political will and effectiveness in addressing homelessness throughout San Diego County. Good actions get shamrocks. Those can and should be replicated. Bad action or inaction get shipwrecks. And the whole premise is like, if elected officials are taking meaningful steps forward, we'll be the first to pat them on the back. We do not have any concern for credit, but if the effort's lacking, the pat on the back is going to be lower and harder, and we're not afraid to do it in a fact-based, level-headed way if we think it's going to compel political will. So these are a few different milestones of some of the various programs we've been able to roll out. It's hard. I've probably taken way too much time already. It's hard to be concise with all the different things that we do, but bottom line is, I tell people we fund, activate, and lead programs that are tangible and measurable and meant to have a high and immediate impact. And the last thing I'll say is we've prioritized youth and we've prioritized seniors, two segments of the population that are highly vulnerable, that largely can and want to be helped, and where we think we can move the needle with our precious limited philanthropic resources. So it's feel strongly about what we do, feel strongly about the issue, and we're all about helping people as quickly as possible find a bright and immediate pathway off the streets.
Well, Drew, we at our earlier event, I had a chance to meet a couple of the other board members, newer board members to Lucky Duck, and you obviously have some incredibly talented people that love your mission. I know that Peter Seidler of the late Peter Seidler of the Padres, that Lucky Duck was one of his very, very, very favorite nonprofits, as Bill Walton as well. And the amazing Bill Walton loved Lucky Duck. So thanks for what you do. Thanks for making a difference. Just so those of you who know that are listening to this event, whether it's listening to it live or listening to it on a recording or on our YouTube channel, 20% of any revenue that comes from anyone who chooses to use the Opportunity Zone Fund you're going to hear about with our friends from Pinnacle Partners. Anybody who chooses to go that direction, phenomenal organization, you're going to want to use them. 20% of any revenues that come to us as a result of that, as a registered investment advisor, we're donating directly to Lucky Duck. And then that gets matched dollar for dollar by another Irish person. There's no time to the Kelly and the Kilkennys, but we go back to the mother country. But no, we will want to make a difference, and that's one way we can do it. So please reach out to Drew. Drew, what's a good email address for people to reach out to you, or a phone number, so that they can
right there, drewm@luckyduckfoundation.org. I can put my number in the chat, and or it should be on the website as well. It should be pretty easy enough to track me down.
I encourage our listeners to just shoot an email in, sign up, QR code it, but find out more. Just they have a terrific website as well as just a very thoughtful email that comes out on a regular basis. So, but not too regular. Not too regular. Okay. Well, thank you, Drew, for being with us. I'm going to switch over now and just give you a couple ideas. The most important idea from today is how can we reduce, defer, or even eliminate the taxes on capital gains? And as one CCIM commercial real estate advisor who heard me speak several years ago, he said, when I ask people, why are you here? Why did you come to this lunch today? Or why did you come to this webinar today? And one of the gentlemen from the back quipped, RJ, you had me at capital gains taxes are optional. And so I'm here to tell you that some of the biggest clients that we've engaged, in fact, a $200 million family, not last year, but the year before, he had me repeat what I said when I asked him. I'll call him Steve. That's not his real name. But Steve, are you aware that capital gains taxes are optional? And then I just paused. And he thought he misheard me. He said, excuse me, could you repeat that? I said, yeah. No, capital gains taxes are optional, but not only that. Federal death taxes, federal estate taxes are also optional. You don't have to pay them, and you won't go to jail if you don't, if you do something else instead. And we'll be unpacking at least one idea that if you choose to use it, not only can you eliminate the taxes on the sale of a capital appreciation asset, but you also get a tax deduction for doing it as well. Because Americans have always been wildly philanthropic, and most wealthy, affluent Americans understand that they have an obligation to support the social well-being of the country. For all its faults and for all the craziness, things that, that just happen like today, it's still the best country in the world. That's why so many millions of people are desperate to come here. But for that, unfortunately, most professional advisors, their attorneys, CPAs, financial advisors, and again, hope I'm not offending anyone, but they just don't bring up philanthropy. They just don't either understand some of the tools that have been in the tax code since 1969, the Tax Reform Act of 69, or they just don't do it themselves. So they, unfortunately, many of our advisors don't bring it up to their clients, which is really a tragedy because we can, in fact, opt out of capital gains taxes, estate taxes, a third to half of income tax, by just the thoughtful use of certain tools, techniques, and strategies that do good things for you and your family, as long as you're willing to also do good things for other people's families or organizations or amazing groups like Lucky Duck that are having such an impact for good. So with that, let me go ahead and just share with you a couple of flyby. I'm going to really sail by, and because I really want us to spend the bulk of our time listening and learning about Opportunity Zone funds, and in particular, a fun date from our friends at Pinnacle Partners, and Jeff Feinstein will be with us momentarily. So how many of you, by show of hands, digits, fingers, noses, whatever, have ever heard of a 40-year tax-deferred installment sale? Well, if you're like me, up until a couple of years ago, you may not have heard of this before, and it certainly was new to me. But there are, in addition, there's a special code section 453, which just allows someone who is selling an appreciated capital asset like a building, shopping center, apartment, so forth, to be able to sell and defer the recognition of the tax until they begin taking income. For example, I helped a client in Florida. They had three bakeries. If I mentioned the name, you would go, oh my gosh, you bet. I have been there, and we as a family have been there plenty of times as well. But we helped them sell, and the point there was to not eliminate the tax. What it does in this particular idea, whether it's a 40-year tax deferred installment sale, whether it's 20 years, 30 years, 40 years is as long as I would advise going. It just simply allows us to defer when you are recognizing the income. As you take the income out, we can invest the money and defer the recognition of the tax on that, on the invested portion. But as you begin taking money out, you pay taxes as you go. So it's kind of, in a nutshell, it's not any more sexy than that. But in this particular case, we were hired by a client. Wealth Legacy Group is a consulting firm. So we get hired by high net worth families and clients or other professional advisors that bring us in. And in this case, it was an almost $12 million building and happened to be in a very unattractive city in Northern California. I'll leave it at that. And they wanted to sell. The challenge for them is that they didn't want to do a 1031 exchange. They didn't, for several reasons. That was an unattractive option for them. But if they didn't use a 1031 exchange, they were looking at 37.1% tax on their gains. And they had about $8 million of that 11.7 million was gains. So what could they do? And so just as a refresher, in this lovely state that we call California, with approximately 11.7 million and the $3.7 million cost basis, that $8 million of gain would be subject to 20% federal long-term capital gains tax, 13.3% tax in California. We have no long-term capital gains tax. It's all taxable as ordinary income. So I'm sure many of you have become painfully aware. There's also another 3.8% Medicare surtax. Thanks, President Obama, on that one. And there's usually a little bit of junk fees that come from various little smaller taxes, but just using these three, that by itself puts us in a basis where we would have $3 million in taxes all in. And from that, walk away with about 8.7 million. So here's the long and short of it. To sell that appreciated asset, and this is not even taking into consideration all the fees for the realtors and the closing costs and other expenses, just purely from the taxes alone, 37% in California, if not doing a 1031 exchange. But using that 40-year tax-deferred installment sale, and just simply comparing the taxes, if we went ahead and paid the tax now versus deferring the tax and just merely paying taxes on the income distributions, well, you can see right out of the gate, we're at over $140,000 more income in just year one from choosing to defer the tax and merely take the earnings off of that sale. And how about as we go down the road? Well, in year 40, the income would have been $826,000, but instead we would have been over $1.1 million of income. Now, next thing to consider though is, okay, well, I can either pay the tax of $3 million today, or what if we choose to wait? The gain, the amount of taxable gain doesn't change. So that's a big question that comes up oftentimes, RJ. By waiting 20, 30, 40 years, does the tax itself change? And the answer is yes and no. No, because the gain is going to remain $8 million. But could tax rates change? Have we seen tax rates change? They've gone up, they've gone down, but more often they've gone up and stayed up. So what kind of sense does it make? Should I just go ahead and pay the tax bill now? Well, it makes sense to defer paying taxes in most cases, but we do an analysis to measure the numbers of the economic impact. So if we could pay taxes now, so 8.7 million grows, assuming just merely a 3% growth rate and a 3% income rate, that 8.7 would grow to 16 million, almost 17. But if we defer paying the taxes until the end, our 11.7 million would turn into $22 million, again, assuming just a 3% growth rate. And I suspect you can probably grow your value of your real estate more than 3%. Here's the thing that we have to look at. Could tax rates increase? Not only could they probably will. But would they increase by over 72%, which is the tax rate? That's the break-even point. So if you think the tax rates will increase by over 72%, then probably pay your taxes now. But one of the things, the advantages of the 40-year tax-deferred installment sale is that if we see tax rates are going to change, we always have the ability to go ahead and pay the taxes and not wait for 40 years. If it makes more sense to pay at year 20, we can do that. If it makes sense to space it out and pay it over several years, we can do that as well. So again, not to spend any more time with it, that's just an idea that you may not have seen before. And as I said, I had not seen it myself until just several years ago. Who's working in this space? Some of the largest life insurance companies in America. Prudential, Metropolitan Life especially has a whole division that's involved in its space. Quickly moving on to another idea. Using 1031 exchanges, like-kind exchange, to defer the tax, but instead of having to buy other real estate assets, What if we use something called a Delaware statutory trust? That name may be familiar to some of you. And the question is, well, what if I don't live in Delaware? Can I still take advantage of this particular tax benefit? And the answer is yes. We do this regularly. It has to do with the way something is constructed. And it was first done, and IRS gave it approval on a trust in Delaware, hence the name. But bottom line, what it does is it allows us to take that, say, that $11.7 million office building, and let's just say that they're working with a qualified commercial real estate advisor who finds maybe an $8 million shopping center that is perfect, but that's 8 million of the 11.7. What about the other $2.7 million of gain of sale value that they would have to pay tax on if they didn't use up the full 11.7 million? Well, what a Delaware statutory trust can do is fill in the gap. So we can provide, usually in this case, with in my example a moment ago, 2.7 million, we might use 3, perhaps even 4 different projects in different lanes like senior housing or in self-storage units. Some areas where we can defer the recognition of tax, but at the same time, we can get a nice, so we'll eliminate that 37.1% tax. And we can then get an income stream. It's typical to get 5.25, maybe even 5.5% income, all tax sheltered. And then at the end of 3 years, 4 years, maybe 5 years, there's a liquidity event when that underlying asset is sold. And then we can go ahead and defer the gains once again. So what happens though is there's an expansion of the value of the assets on which we're getting that 5.25, 5.5% income that's tax sheltered. So it's a terrific way of diversifying your portfolio. You can find a variety of different projects that will be very high grade commercial projects. And again, in most cases, the income is completely, if not all sheltered, mostly sheltered. Got professional management. The only exercise they have to have is walk into the mailbox for their check, or just simply have it automatically deposited in their checking account. Thank you very much. Quickly now, this is something that you won't find. So if you Google it, you're not going to find it. This is my name for it, but private philanthropic trust. It is a special tool, and I'll give you an example of a real life. Some clients, they found us several years ago, hired us to help them manage a $7.5 million of assets from a sale of a business and the land. The wife, especially Eileen, that's not, by the way, these names are changed, but Eileen did not want to do a 1031 exchange. At the time, she was 83 and her husband was 79. So she wanted out of the tenants, taxes, trash, termites, all those sorts of things, the 4 T's. So they decided not to have an exchange, and not knowing, it created a $2.1 million tax bill. So first they hired us to help them with how to manage the assets and how to diversify the assets. But then after that it was, well, gosh, we didn't realize we were going to have such a large tax bill. Is there anything we can do to mitigate that? And the answer is, fortunately, yes, because I found out they were philanthropic, and yes, because I still had 3 months left in the same tax year. So it enabled us to, we looked at several different ideas, but this was an idea that made great sense for at least a portion of their funds. So we recommended this PPT, and I can only recommend this if it's in the same tax year. We put $2 million of their $7.5 million. We put $2 million into the PPT. It created a $1.6 million tax deduction, mostly because of the fact that they were 83 and 79. But even for clients that are in their 60s, we can look at usually about a 60 to 65% deduction if there's no additional beneficiaries beyond just the husband and wife or the grantors at that age. Now, this was income for them. We've had several times where they've come to me and said, RJ, we just don't really need as much income as you're providing to us because of all the other things you're doing for us. Can we reduce the income stream from this? And the answer is yes, you can. Any income that's not taken out is not taxable. So it just builds up, builds up, builds up. And then if they ever decide to open the spigot up again more fully, they can, and they'll pay tax on the income as it's received. But if it's long-term capital gain income, they'll get long-term capital gains taxation. Not only that, I found out that they intend to leave their $1.8 million home, beautiful home up at the ranch, to 3 different nonprofits: Salvation Army, Goodwill, and an animal rescue organization. Well, when I asked them if that was still their intention, they assured me that that in fact was the case, that they wanted to leave their home eventually to those three charities and have them share equally in the sale. I asked them one more time, are you sure you're not going to change your mind? Could you ever envision that you might not want to do that? And they were quite adamant. No, that's the plan. Well, in that case, they get an estate tax deduction if they didn't do anything else, but they get no income tax benefits. And the greatest benefit to them is right then, they still needed to offset a whole lot of tax. So what I recommended to them is that we create what's called a life estate agreement, where we just simply went down to the county clerk. We recorded that at their deaths, the property is going to go to those three charities. And so they were the successor, the remainderment beneficiaries is the technical term. That simple action of naming these three charities upon their death, so when the second of the spouse dies, however, please God, that will be a long time from now, we hope. Except we did lose him earlier last year. So, you know, as they say, at 83, you don't buy green bananas. Okay, there is the handwritings on the wall. But that created an additional $1.3 million of tax deduction. So between the 1.6 and the 1.3, we created almost $3 million and eliminated the tax on the sale of their building. Ideally, when we're planning, we want to build a fence at the top of the cliff, but we find situations like this with our dear friends, Bill and Eileen, that they had already gone over the cliff. So in that case, wouldn't it be nice to know that there is, in fact, an ambulance and a net in the valley? But now we get to the feature attraction of today, and probably the reason why most, if not all of you are here, other than those who wanted to get to see the handsome Drew Moser and hear about Lucky Duck Foundation. So I think it's probably everybody after hearing the story. But you're probably here to hear Jeff Feinstein talk about, and Pinnacle Partners, about qualified opportunity zones. And what the heck are they? I thought they got taken, a lot of the good benefits got off the books that they timed out. Well, no, let's hear about that. So with that, Jeff, I was so pleased when I've had the chance to get to meet you for the introduction from Sly. And you opened my eyes up to the fact that there are opportunity zone funds out there that are, they identify what assets they're already going to be investing in. And so between the great tax benefits that are in the tax code, and as well as the things that you are doing uniquely at Pinnacle Partners and now in Fund 8, without further ado, my friend, the floor is yours.
Thank you, RJ. Thanks for the opportunity to be here. RJ's been a fantastic partner. Clearly, he's expert in all sorts of tax advantage strategies. We've had the benefit of working on several client-related issues, and already I think we've allocated a couple $1 million of capital gains into our Fund 8, which is closing imminently. Earlier today, I had the opportunity to meet with Drew, which I appreciate meeting you, Drew, and looking forward to donating to Lucky Duck and the potential for future collaboration. We have an actionable opportunity zone fund closing actually at the end of June. It's a unique opportunity for RJ's clients where they can be the last money in if they're so interested in obtaining this incredible tax shield, which I'll describe in a moment. But know that we've been enjoying the very swift fundraising process. We've got about $85 million already into the ground. We're seeking to close the fund at the end of June. So as RJ said, there's a lot of funds out there that come to market blind. That is, they're not identified projects. They may be permit ready, but not yet, with construction financing. As you will see in a moment, this fund is progressed quite a bit. We're in lease up in one particular property. We're in construction on two more. So it's a very unique opportunity for RJ's clients. And I apologize in advance for any background noise that you might hear. So I'm situated at an airport. So very quickly, the Opportunity Zone legislation was enacted in 2017, along with other tax cuts and programs. And we seized upon this. We saw this as the most compelling tax shield ever enacted by the IRS. And so let's describe the benefits and the reasons why we believe that to be the case. Number one, you generate a capital gain, short or long term, from the sale of any source, and I'll speak to those scenarios in a moment. You can invest in an opportunity zone fund within 180 days of realizing that gain and immediately qualify for tax deferral. So the tax associated with the gain is deferred until 2027. That's benefit number one. Benefit number two is you get to use depreciation, and I'm happy to talk in greater detail about depreciation, but it's a very tax efficient tool that offsets income. So this becomes kind of a tax advantage solution, again, unlike any other, because there's no recapture, which is a bit of a technical term, but ultimately you can use depreciation, but you got to catch up and repay the tax associated with the use of that tax advantage. So the opportunity zone is without recapture. And the final and the most compelling benefit is that the appreciation in the underlying real estate. So if you invested $1 million as an example and it grew to $4 million after a 10-year holding period, the $3 million in appreciation is tax exempt. You pay zero capital gains, zero tax on that appreciation. And that's hugely wealth building and compounding of a gain that you would otherwise have paid tax on and then likely reinvested in another taxable instrument. So those are the three benefits. Our firm was founded in 2018. We've been executing on this exclusively. We funded close to $2 billion of multifamily development and on a variety of funds. And this is our Fund 8 closing at the end of June. And this slide reflects that you can generate a capital gain, short or long term, from a variety of sources, not just real estate, which a 1031 is exclusively, or a DST is exclusively for real estate sales. This can be appreciated stock, obviously real estate sales included, a sale of a business, carried interest. If you happen to be in a hedge fund, as an example, you may own a little bit of crypto and have enjoyed, kind of a big bounce up to 70,000, or even art and collectibles are all considered, when sold, with appreciation, to be generating the capital gain. The last item here is partnership interest. Many of our investors are receiving their K1s later and later, and they may have received them well past the April 15th deadline, and they discover that their manager has generated capital gains that were unanticipated. Many times those partnership interests have differing dates of qualification. So if that is your case, please consult with us, because we have tax advisors that might be able to qualify a 2023 capital gain with an investment in 24. So you can still mitigate taxes in 23 by investing in an opportunity zone in 24. So very quickly, what we've done is we spent the last 2 years identifying, to RJ's earlier point, sourcing and controlling and ultimately executing on 5 discrete assets in well-located markets. And I'll describe those markets in a moment, and I'll just give one slide on the benefit to RJ's clients, which is this last money in situation. So different than other funds, you might get them early in their launch and formation. We are obviously late stage with an imminent closing, so that allows you to look at the various projects, the progress of those projects. The full portfolio is revealed and known, and you get immediate return on the invested capital. So moving on quickly, these are the 5 markets we chose to invest in, and that is Phoenix, Dallas, Denver, Austin, Charlotte, and Nashville. These are high growth markets. They've got great diverse economic bases. They've got outstanding employment and room to run in the rents. Everything that we invest in is multifamily, institutional size and grade multifamily, and we have a particular high conviction on built to rent, which I'll share with you very quickly. So in Denver, as an example, we're located next to the Denver Broncos Stadium District, which is formerly an industrial area. But very quickly, based on the Walton family's recent purchase of the Broncos, as you can see here from their master plan, they intend to develop what is currently surface parking into multifamily, entertainment, retail venues. And our project is right here where the star is, and adjacent to the river, close proximity to 2 universities. This is Ball Stadium when the Nuggets play, and this is the downtown corridor. So this is the project now going vertical. This is an old photo. We're actually topped out at the 8th floor now. In Charlotte, we've got a build to rent solution in NODA, if you're familiar with the market, a fast growing market, a middle class community that was in need of this type of product. This is a townhouse product available for rent. This is currently constructed, and now, as this slide reflects, we are now leasing this particular project. So we're generating cash flows already in this project. And we are here where the star is, and all this is intended development all around us. So we think we're extremely well located. In Avondale, which is just outside of Phoenix, the fastest growing city in America, we're delivering single family detached homes for young families that are seeking that type of living environment and proximate to schools and services. They can't own a home due to the high rates associated with mortgages, but they definitely want to live in a single family home, have a sense of community, have an amenitized community, clubhouse, pool, etc. And so that we're building this community, 107 units of single family detached, and then renting that to these young families. So this is our lot size, probably better depicted here. You can see we've got the ground, and we've just started vertical construction on this project as well. In Nashville, quickly, this is the East Bank on the other side of the river, opposite the downtown. And this is all emerging quite rapidly because Oracle has located their world headquarters here, number 1. This is our multifamily development. Approximately 300 units will deliver much needed housing to this submarket. And this is the Tennessee Titans Stadium that just received a $2.5 billion bond to renovate the stadium. So we're big believers in these stadium districts as a path of progress. And then lastly, in Austin, we're delivering workforce housing for those that need to live near work. And this happens to be 5 minutes. Here we are, 5 minutes from the Samsung chip fab, which is committed to employ another 22,000 additional employees. And we're going to offer much needed housing in this submarket in North Austin. So that's a quick review of the underlying real estate. It's a quick review of the opportunity zone legislation and the tax benefits associated with it. If you've had a gain or plan to sell maybe some appreciated NVIDIA stock, you should really consult with RJ as maybe making a pair trade, creating a gain, and investing in an opportunity zone to begin to build a real estate portfolio in the most tax advantaged way possible. So RJ, I'm going to stop right there. If there's any questions, happy to take them. That concludes my presentation. Thank you.
Thank you so much, Jeff. I enjoyed that even more. And I already have heard it because we have now up to 3 million, and we've got another couple of clients that hopefully are going to be able to get their slices and their tranches in before the fund closes. But speak to that, I guess. For those that would like the opportunity of investing in Fund 8, what kind of timing does that look like? If they have a transaction, for example, that might be closing, but they really don't know yet what that date is going to be. How does that work?
Yeah, you have to generate the gain. You have to realize the gain before investing. That's a stipulation. So what we can work on a situational basis. If somebody has a planned sale, it closes, say, July 4th. So I think there's some room around the edges, but we are intending to close June 30th. So I would advise your clients to look back 180 days and determine if they have realized a gain. And again, many of these are unplanned because they just got their K1 and it was a good year for a fund manager and they might have some gains. You can trigger a gain if you invest in public equities. You could trigger a gain tomorrow. by selling a particular stock. So that's what I would advise if there's interest in partnering with us. But we really do have that hard close at the end of June.
Okay. Well, and that leads into a great question from Shelley Brown, wonderful estate planning attorney. So Shelley, great to have you with us. This is really, I've got Dan Lee, who was the 2006 Home Builder of the Year. So we've got some pretty high-powered folks listening to us today. So good to
Excellent.
see y'all. Shelley asked a question about investing from a qualified plan, let's say a 401k or a profit sharing plan. Could you address whether that is permitted under the code? But then there's also a question that came up earlier in our other event. What if you don't have a appreciated asset sale? Can someone invest into an opportunity zone fund and still get the tax goodies?
Yeah. So Shelley, what I'll say is, number one, you may be thinking, haven't asked, but we do see a lot of estate scenarios and generational skipping trusts and other vehicles like that, and they all conform and can act as investors in an opportunity fund. But to your specific question, I mean, a 401k is by definition tax deferred. So you could invest, you would not obtain any of the tax benefits that I described. And that obviously would apply to anyone else investing maybe outside of a 401k, just what I call a non-gain. They can invest that as well, just because they want exposure to this great real estate portfolio, but they would not enjoy the opportunity zone benefits, because that requires the investment of a capital gain.
And the idea behind that, Jeff, if I might, is because they're trying to bring capital into some of these underserved markets. That
Correct.
was the original idea. Tim Scott, the senator from South Carolina, and Cory Booker, I believe, was the
Democrat. Mm-hmm.
Also in the Senate, and they co-sponsored the bill that then became part of the 2017 Trump tax bill, the Tax Cut and Job Act, where opportunity zones were created. And the goal was, I think you mentioned 8,700 different zones across the country. And California, I was surprised, I learned from you again today, California is the largest, has the most replete number of tax opportunity zones available in the country, which I guess shouldn't surprise me, as big as California is, but still.
Yeah. So a couple points there that you made, I'll just embellish. So the program was intended to unlock these passive, unrealized gains, 7 trillion of them estimated to be in the market, in the stock market, and then give them an incentive to exercise and realize the gain, and then redeploy them and create economic activity. Because when they sit in Tesla, they're not really generating economic activity, but maybe to the benefit of Tesla, the enterprise. So it was, if you remember, Treasury Secretary Mnuchin launched this program, and he estimated at the time $100 billion will be invested in opportunity zone. Well, we think it's closer to 400 billion already, and we still have runway. And then you take the 400 billion and then you put kind of a 7 or a 10 times multiplier on that, because that's the economic activity that's created from the investment that we make in any one of these projects. What I just previewed is several $100 million worth of construction costs. Correct. So that's the macro intention of the program. The program's been wildly successful and will likely get extended. So as I said before, your tax is deferred from the original sale of the gain until 2027. It's likely that gets extended to 2029.
Well, and it's sort of hard. We've had so many different things we've been talking about and talking at today. It's hard to keep track of what did we say already. But not only that, but the 10%, maybe even 15% basis boost
Step up.
that hopefully will be coming back, which just basically, I like to think of it, is that they're reducing the tax bite by 10%, maybe 15%. Also, what are the disadvantages as we sort of start landing the plane here, coming in for runway? What are some of the disadvantages of investing in an opportunity zone fund, even as one as brilliant as yours as well?
Well,
Put you on the spot. We didn't talk about the ahead of time. Sorry about that, but
that's okay. I mean,
nothing's perfect.
nothing's perfect. I mean, this is real estate investing. I mean, it just happens to have the OZ wrapper on it, just like any other piece of real estate. We think we do it better than most, but there's inherent risks with real estate. Um, we are not in retail. We're not an office. I mean, if I was presenting an office portfolio, I think there'd be a lot of risk inherently due to the return to work situation. But there's clearly risk, and I won't enumerate all the various risks. We've tried to take a lot of risk off the table, and being the last money in is probably the least risk scenario one can consider. But we believe, and the reason why we deliver on multifamily and all types, by the way, not just this fund, but all of our other projects, it's affordable and workforce.
And student housing too. I think you've had some
student housing. We have 3 discrete projects. We're delivering about 2,000 doors in the next 15 months. Is that we're terribly underhoused as a country. We're 7 million households down in housing stock, and we haven't had a lot of new housing stock to replenish the old legacy housing stock. So, we think there's plenty of demand, but demand shifts and changes over time, and that would be a risk.
Well, and having a fully specified portfolio as you do with Fund 8, and in those unique areas that, again, some of that is through shrewd research on your part. Some of it is good old darn Irish luck. So I think that the lucky duck was already helping us out here along the way with the good luck. But clearly, Phoenix is exploding because of the CHIPS Act and billions of dollars flowing into that marketplace. Austin now, similar as you pointed out, with Oracle's home office being there. So there's just a lot of good things that are happening. Fund 9, let's ask about that, because what happens when Fund 8
Can we have some basic investment criteria, on the current investment? I guess I'd like to know. It sounds like you're pretty far along in the construction, and obviously with inflation, how are you relative to your actual budget versus projected budgets?
And that question has to come from, again, the 2006 Home Builder of the Year, Dan Lee. So hi, Dan. Good to hear your voice.
Hey, RJ.
Did you get that question, Jeff? Did that come
I
across?
did indeed. So Dan, I was interpreting first. I understand cost and budget, so I'll get onto that. Were you asking about the terms of the investment? Because I did not discuss that. So very quickly, I'll just share. Your money comes in, gets the aforementioned tax benefits. The deferral is immediate. You begin to earn a 7% preferred rate of return. We're targeting an 11 to 12% IRR over 10 years, Dan, which in a merchant build situation, you might be looking at 3-year holds or 5-year holds with higher rates of return. But, the denominator factor applies here on a 10-year basis. We have to hold for 10 years to accomplish tax exemption. Now, and by the way, we have a waterfall, 85-15, very generous, we think, and maybe market leading, where other funds might be 70-30. So 70% goes to the investors, 30% goes to the sponsor, in this case, Pinnacle. We have 85-15, 85 to our investors.
Yeah.
Thank you. Now to your question, costs. You know better than I, but probably. But we had a spike in lumber, as you know. It was a parabolic rise. It's had also a significant retrenchment. We're getting GMPs. There's slack in labor. We're getting predictable pricing, and we don't have the supply chain impact that we once did. So on the cost side, we're doing pretty well. Interest rates have been rising clearly 10 times consecutively, and that has had an impact on our construction financing. But construction financing, as you know, is short-term in nature. Again, considering a long-term hold, doesn't have a big impact on the IRR, assuming that rates do come down. And obviously the Fed did declare rates will be reduced. We don't know when, maybe it's next year, but I think they're going down over time, and that'll be beneficial when we refinance into permanent financing. But we've been at this very cautiously and prudent in optimizing each step of the way. And I think we've done really, really well. We don't guarantee anything, Dan, nor do our investors. They're indemnified from that. It's the sponsor that guarantees the construction loan. So we've done a really good job of immunizing ourselves, controlling our costs, and we're generally on schedule.
What's your loan to cost with your bank right now?
Good question. So LTCs ranging between 55 and 60, probably average all 58. We don't do anything highly leveraged.
I think one of the things that some will want to know is when Fund 8 closes here coming up, like a freight train, middle June, maybe late part of June, what comes next? So if they miss this one, do they get another bite out of the apple at some point?
Yeah, they do. And, we can have a separate webinar on the subject of build to rent. We have some resources on our website, pinnacleuzi.com, that talks about build to rent and why it's such a compelling product type.
And
the next
Jeff, you're a
fund,
buyer also. So you might want to explain that as well before we close. When at lunch today, you were explaining that you guys are actually a buyer as well.
we're looking for other opportunity zone projects. We've been looking in San Diego for well over a year. And so in our earlier presentation, we talked to people that could source land for us. And so we've activated that, and we're really excited about that. And maybe we can partner with Lucky Duck. We can partner with other real estate professionals to deliver most likely workforce or affordable. Getting a quote, what's the acreage you're looking at? Somebody presented us with the 3.2 acre site near urban core. We're looking to deliver on average 120 units to 150 units. So not, sub 100 units. So that's kind of our criteria.
And Jeff, in that case, with that 120 to 150, what size of acreage does that?
I'd say kind of, and you can do some interesting things with small lots, but kind of, let's just say 1 to 3 acres.
All right.
As you can see from the pictures I shared, we prefer to be outside of the urban center. We'll get a little bit more land. We love that garden style development that I shared with you in Austin, where there's everything surface park. We'd rather not. When we do affordable solutions, we do them without parking. So we're not going to excavate, which does reduce costs. That's important to the whole thesis, is managing costs for affordability.
Well, and as you know, one of the reasons that really caught my attention about what you're doing at Pinnacle Partners is the fact that you're building quality housing for people that can't afford to go buy their own house. They're the people that are law enforcement, they're firefighters, they're nurses, they're social workers, they're teachers. They want to live in the same city they work. That shouldn't be that hard of a concept to grasp, but unfortunately, that's just not that's not an activity that most people can afford to do in many of our cities like San Diego and Los Angeles and New York and other places, that you're able to build these quality homes that people can afford, and they make great long-term renters. They're great people, and they have families that they want to be able to provide a quality housing and protected and safe housing too as well.
That's right. Yeah, and I just maybe for Drew's benefit also, and let's see, and Shelley's still on. Yeah, this project here it was sold to King County. Now provides transitional housing for the homeless, but this was 95 units of what we call CEDU styles, small efficient dwelling units, and this is across from a lot of public services. We replicated that in Los Angeles. This is 1317 South Ground. It's now opened and master leased by LA County. Very similar design. And then this project here is a massive 400 units near transit in Seattle. These are all closed, of course, but I'm just giving you examples. Again, all small, efficient units. And let's see, this Heartwood here is a public-private combination with Community Roots Housing that delivers affordability at the 60% AMI rate throughout Seattle. So those are just some examples, and you can see how how they're designed. Of course, some of these are renderings, some of these are actual pictures, but that's a portion of our portfolio in and around urban core for affordable housing.
Perfect. Well, again, Jeff, I learn something from you every time we talk,
Well,
and
it's
you've
great.
worked you for a long time. Safe travels back to Washington State, my friend.
Thank
Again,
you.
thank you to Drew Moser and Lucky Duck Foundation. And I want to give a shout out also to Caitlin, who's on our team, our marketing and event manager, who just does a brilliant job. And I try not to mess it up too much. So I know I'm going to get my hand slapped on a couple things from today, but okay, fine, you know. Thanks everybody. So you can reach us, Wealth Legacy Group, at 800. Actually, no, we just stopped our 800 number. Okay, we're at 858-569-0633. That's 858-569-0633, or just shoot us an email, info@wealthlegacygroup.com. Info@wealthlegacygroup.com. Ask us any questions. We can make introductions to Drew, to Jeff. There may be some other things that you want to have a conversation about, whether it's wills, trusts, insurance, investments, tax mitigation. That's the kind of stuff we love to do and help. And anyway, God bless. Thanks so much for being with us today.